We're at the Ponzi finance cycle. I was talking to my friend, Dr. Lacey Hunt. You know, he's not predicting a Minsky moment, but he thinks the risks of a Minsky moment are increasing as we roll through this year.
What's
the
a
Minsky moment is a massive credit event that causes, deflation and an unwinding of leverage. And that happens at the end of a long economic boom. We're at the end of the boom, like we saw in the great financial crisis. Ponzi finance, where you're issuing loans to pay off old loans, and the cash flows aren't there to support it. Eventually, the chickens come home to roost.
You're watching CapitalCosm. My name is Danny. It is June 17th, 2025, and I am not centered correctly. Hold on. All right, now I am. Ed Dowd is our guest today. Ed, thank you so much for coming on the show, my friend.
Hey, great to be here, Danny. Love coming on here. Thank you.
Yeah, it's always a pleasure hearing your insights here, Ed, especially, you chose a great time to come on. So it's not like we have a shortage of news to talk about, but I'm going to open the door to you. Obviously, you've got the Iran-Israel war, or quote-unquote war. It could, some may call it a war, some may call it a conflict. We'll see whether it escalates or not. And we've got a bunch of other economic indicators that you've been looking at as well. But I'll open the door to you. I'll let you kick it off whichever direction you want to kick it off. What do you think should be most prominent on investors' minds right now? Clearly, we've got the Iran war going on. Clearly, we've got all of the calls that you've made in the past. So go ahead, Ed.
Yeah, sure. I mean, we put out a report on January 9th, Dangers of a Deep Worldwide U.S. Recession, or worldwide recession driven by the U.S. And the crux of our thesis was the reversal of illegal immigration, which had been holding up the housing market, which is in trouble. And if you had asked me on January 9th what my conviction level was, I was highly convicted. You roll forward 6 months, we put out a couple of follow-up reports, which were much cheaper than the initial report, new tenant rent analysis, and we analyzed the multifamily construction, which we think is going to be the highlight of this next housing downturn. It's going to be known as the multifamily housing debacle. And everything we've looked at is rolling over, and it's baked into the cake. The only way to correct the home unaffordability at the moment is lower prices, and supply is coming online. Construction activity is rolling over. We have real yields at 2%, which are very high. The cure for real yields will be slowing economic growth. The Fed will eventually have to lower. So, I'm more convicted now in our call than I was 6 months ago, because the data is being borne out. And you're going to start seeing this being more talked about as we roll through the next 6 to 12 months. It's going under the radar because we have a lot of headlines about, protests and now the Israeli-Iran conflict. On that note, that conflict, if it causes the price of oil to spike or double, that will obviously our thesis is inflation's coming down. It's going to be sub 2% sometime in the next 6 months, driven by shelter, which is 36% of the CPI. Housing, including the ancillary services around shelter, is 45% of the CPI. So that mathematically, that's all going to be coming down. If we get a doubling in the price of oil, that'll obviously make inflation noisy short term. But I want to, warn people: a doubling in the price of oil, it's the delta. Something that occurs that quickly will cause demand destruction, just like we did in 2008. Oil peaked in July of 2008 at $147, and then subsequently we had an economic collapse. So our thesis, if oil does double, will only play out faster. So don't get hung up on that inflation's going up. It'll cause massive demand destruction and slowing global economies. So the price of oil recently has spiked a little bit. It's only back to where it was before the tariff problems. So it hasn't broken out yet. So we're watching it. So the price of oil is important to watch. But if the conflict, which honestly, I don't think anybody has a read into what's going on. There's a lot of bluster today. Trump is talking about unconditional surrender. He put that out on Truth Social. So there's a lot of noise. I'm going to watch the asset markets, and if oil really breaks out, then we know something really bad's coming. So right now it's contained. I'd say this is just speculative in nature at the moment, but if it breaks out, we got problems.
Right. It's the old adage, and the cure for high prices is high prices. But if something external happens, like the closure of the Strait of Hormuz or something to that effect, can oil prices come down substantially enough to to a sustainable level?
What do you mean by come down? I mean, if the Straits of Hormuz are closed, they would spike immediately. I
Right.
don't follow.
Right. But if we're looking at the spike, and if a coming spike in oil does occur, you do have you do have these high prices, which creates less demand.
Oh yeah, eventually the price of oil will collapse as economic activity chokes. That'd take some time. That would take several months, but eventually you would see oil peak, roll over, people would be all bullish energy stocks, but it's an external shock, not and it's an exogenous shock, not endogenous to the supply and demand dynamics of the oil market. So
And how would go ahead?
So eventually prices would come down as demand collapses, but that would manifest over several months.
And this would be a worldwide prognosis, or just a U.S. centered?
Oh, the whole world would. If oil prices double, the whole world economic activity just rolls right over.
Understood. What are we? I mean, we're seeing the price of oil relatively subdued right now. This is all speculation right now, obviously.
Yeah,
but
correct.
Why
we're just shooting the SHIT right now.
Yeah. Why do you think oil prices are subdued despite like this backdrop of kinetic action between the two countries?
Well, oil prices, interestingly enough, Carlos and I, my partner, have looked at oil prices, and they have not kept up with inflation. They're very cheap versus inflation. I mean, like I said, in 2008, we had a $147 per barrel oil price, and now we're at 76. So what's gone on? Well, the shale the shale oil that came online after the great financial recession added a lot of supply and made the U.S. energy independent. During the Biden administration, we were exporting 3 million net barrels per day. So that made us energy independent, and that changed the supply demand dynamics of the oil market. So oil is very cheap versus inflation. So even if it were to double, it would take us it would catch up with the inflation we've seen since the great financial crisis. So oil has its own supply demand dynamics, and the shale oil was really a big deal that changed the game and made the U.S. energy independent.
If you look at past times in history to kind of search for precedents, when you had World War I, World War II, or any major war to that effect, I mean, those are obviously exceptional wars, but nonetheless, what happened to the global economy? We had the Great Recession prior to World War II, but during World War II itself, how did things really shake out for the U.S. and global economy back then? So, if we try to extrapolate out into the future, and if this thing does escalate further into a regional war, what can we really surmise based on history?
All conventional wars are inflationary over time. We basically didn't get out of the Great Depression until World War II. If you think about what happened during the dot-com boom, the economy kind of reignited after the move into after 9/11 and the move into Iraq and Afghanistan. So conventional wars are inflationary. Initially, there'll be a deep recession. Then on the other side of it, it would be inflationary if we get into an extended, prolonged regime change conflict.
Gotcha. And the dollar, you did mention the dollar. Here's the DXY here. We're at a 98 level at the time of this recording. It doesn't seem like the dollar's been really impacted much from the events of the last several days. What can you make of the dollar's price action as a consequence of what we're seeing in the Middle East?
I'm looking at the bigger picture in terms of cycles. I have a friend, Tim Wood at cyclesman.com, who does great analysis of different asset classes and their cycles. He's identified a 4-year cycle in the dollar and he said last summer he's looking for the dollar to bottom sometime in Q1 or Q2 of 25. And as long as it bottoms above the last 4-year cycle low, which was 89.10, then we have the bull market in the dollar since the great financial crisis intact. So we're looking for a low in the dollar sometime, in the next month or two, and it's going to shock a lot of people when it takes off and goes up and to the right. That the reason why we might have a dollar rally at this point is if we get going into a deflationary recession, that's good for the dollar. That's credit destruction, and demand for dollar liquidity will go up in a global recession. So that might be one of the reasons why we're getting close to a 4-year cycle low on the dollar. Consequently, we have one of our biggest calls in our report is that you want to be out of risk assets into safe government assets like the U.S. Treasury market, preferably T-bills if you don't have any risk tolerance. But if you have more risk tolerance, you can get into the 10-year and the 30-year bond if you're more speculative. We think yields have peaked, and we're coming on an important cycle low in bonds as well. So the asymmetric trade, the trade that everyone is on the wrong side of, in our opinion, is overweight risk assets, underweight duration in the Treasury market, because it's been one of the worst bond bear markets in the last 50, 60 years as a result of the Fed's zero interest rate policy for 14 years and then quickly raising it to 5.5%.
You're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
Started cutting, but that is not at the moment. The market's on they're on pause in interest rate cuts. So we expect to see the Fed react to hard data going south. We expect the stock market eventually to crack. Right now, the stock market had a little wobble and sell-off during the tariff news, which was, an exogenous event, and an event that can be turned on and off. Trump created these dynamics where he imposed crazy tariffs, then he removed them and put pauses on them, so the market rallied back. So we could be in the midst of summer trading, which will last the next 2 months. We could go to a new all-time high in the markets, but I'd be even more bearish if we did, because corporate profits are coming down. The real estate market is rolling over, and that is 20% of the consumption economy, and that will cause the job layoffs to start to uptick, at least in the housing construction arena, which we see construction starts have rolled over. Construction completions are rolling over, meaning projects that were greenlit 6 to 12 months ago are coming to the end of their building process, and that'll hit as new supply. And there is no demand in the real estate market. We're seeing more sellers than buyers at the moment.
Yeah, another case of high prices curing high prices. I want to dissect some of the stuff you talked about just now. Let's go ahead and look at the dollar really quick. You mentioned a 4-year cycle. Oops, a 4-year cycle. So we've got the DXY here, and it's very fascinating insight here, because if you look back 4 years ago, 2021, you had around 89. You hit about 89 on the DXY, which is what you alluded to. 4 years prior to that, it was 2017, right? You have another bottom here around the same level. 4 years before that, 2014. Right? So 80. So go back another 4 years. Boom. So you're around the same, 2010, 2011, another bottom. Before that, another bottom. So a fairly reliable indicator. I've never heard, this is my first time hearing about this. So what causes these 4-year cycles? Did you ever get
that remains a mystery. It's probably got to do with lots of multiple factors, but it seems, if you're a technical analyst like my friend Tim Wood, you really don't care about the why. You just want to make sure the relationship and the timing still works, and it has worked with much regularity. And again, we had a dollar bear market going into the great financial crisis, and coming out of it, we've had a dollar bull market. And I know it's hard to believe because everyone's talking about the death of the dollar, but we've been in a stealth dollar bull market since the great financial crisis. And again, if we go below 89.10 on the US dollar, the DXY, then we might be in a new regime. We might be in the beginning of a dollar bear market. But until it goes below 89.10, I'm under the assumption, and given the timing band we're falling into in Tim Wood's work, we're going to be hitting the low momentarily in the next month or two, and then a new rally begins. So, if it breaks trend line, that's something to be concerned about. But until it breaks 89.10, this is still a bull market in the dollar, and everybody seems to be bearish the dollar. Everyone's bearish U.S. Treasury, 10 years and 30 years, and I think this is one of the biggest asymmetric trades we've seen in a long time. And you got to remember, a lot of the economic data we had under the Biden administration was just false. The payroll numbers, a million jobs mysteriously have been revised down in the last 12 months. So employment's way worse than we think. Illegal immigration, bringing in 21 million people really did stimulate the economy for 2 years and created what we call a new economic variable. Well, that's all reversing. So anything that was juicing economic growth in 23 and 24 is going the other way.
Right. And you also do have M2 money velocity. I think we spoke about this last time, but nonetheless, it's still topical. You have M2 money velocity appearing to top out as well. So that's
it actually went down a little bit in the last quarter. So we had a second derivative change going into the end of 24, beginning of 25. And then in the first quarter of 25, we've had it tick down. So the velocity of money appears to be rolling over. And if you look at that big spike from the 2020 pandemic back up, a lot of that was driven by illegal immigration.
This here?
Yeah.
And then you've also got M2 money supply. Well, that looks like it's starting to tick back up as well.
Well, it's the rate of change. And you need if you see that big spike up after COVID, the system needs ever increasing rates of supply of credit and the growth rate of the credit to support the collateral underneath. So we're at the Ponzi finance cycle. I was talking to my friend Dr. Lacey Hunt. He's not predicting a Minsky moment, but he thinks the risks of a Minsky moment are increasing as we roll through this year. The Minsky moment is a massive credit event that causes, deflation and an unwinding of leverage. And that happens at the end of a long economic boom. We're at the end of the boom, like we saw in the great financial crisis, Ponzi finance, where you're issuing loans to pay off old loans, and the cash flows aren't there to support it. Eventually, the chickens come home to roost.
Right. And even when you do have these relatively high real yields right now, you said real yields are over 2% now. After a certain point, I mean, is this why Powell hasn't cut rates? Why? What's the holdup with the Fed and not cutting rates? Because it appears that if you're right, they are well behind the curve at this point.
Hugely behind the curve. Two things. They've been looking at the labor market numbers, which have been unfortunately, either fraudulently, calculated and or statistical incompetence. The birth-death model is wildly off, which they use for the non-farm payroll monthly estimate. But the reality that follows it up seems to be way lower in terms of employment. So they're looking at that, unfortunately. I think the labor market hasn't come off enough yet to ease. They're looking at inflation, and inflation is going to be coming down faster than they think. And then what put them on pause, I think, mostly was the Trump tariffs. And there seems to be this belief that tariffs are inflationary, and tariffs are a tax. and taxes are deflationary.
Mhm.
And if you look at the microeconomics on a company level, yes, you get a tariff, and especially if your company's products are elastic, highly elastic, and that means substitutes. So you have a price increase, but the quantity demanded does not increase as much as the price increase. So you actually have lower revenues, which will cause margin squeezes and eventually layoffs down the line. So this notion that tariffs are inflationary, I think, is a little misguided. We put out a free piece on our website about that. The tariffs, we did an analysis. Our conclusion is that they're deflationary over time. Looking at the whole pie, sure, some prices of some goods will go up, but substitutions will be made and demand destruction will occur.
So would it be accurate to say tariffs could be short-term inflationary, but long-term deflationary? Would that be an accurate statement?
Correct.
Understood. Well, we also have the gold price kind of moving sideways. That hasn't really done. I mean, it kind of got a bit of a bid on Friday at the start of the conflict, but now it's been kind of moving sideways. Does the gold price tell us anything in terms of what we can anticipate economically? What can we make of the current gold price action?
Well, gold traditionally sometimes is a flight to safety, depending upon where we are in the gold cycle. But there's something else going on with gold that I don't think is well understood. The Basel III agreements has made gold money again. It's in July this year in the U.S. Gold will become Tier 1 capital. Physical gold, not GLD or gold futures or paper gold, but physical gold. Banks will be able to vault their gold and then make loans against it. And this is a big deal. They're remonetizing gold. We made gold after the 71 taking us off the gold standard by Nixon and the petrodollar birth. Gold was turned into a commodity. Central banks still held it, but now gold is becoming money again by becoming Tier 1 capital, meaning you can loan against it, create money. Banks can create money through the fractional reserve system now. So not only central banks are accumulating gold, but commercial banks are as well.
Right. And then finally, I mean, to kind of go full circle here, assuming that this conflict escalates, what does this do for the rest of your model, the rest for the economy as a whole? What can the average person, the average investor, what can they anticipate happening? I mean, aside from the horrificness of war, from an economic standpoint, what are some of the downstream effects that we can anticipate from this thing really turning into a regional war?
Well, it depends on the conflict. The Iraq war was inflationary from the get-go because it was controlled by the U.S. It didn't bring in other players. It didn't spike the price of oil. It did temporarily, but that went away pretty quickly. This is different. This has the potential to turn into a global conflict. A lot of uncertainty. Risk assets don't like uncertainty. And if the price of oil does double, that'll cause a massive global economic slowing. So, we're going to get a slowing. Let's pretend this conflict didn't exist. We're going to get a recession anyways, in our humble opinion. So this only adds to the uncertainty of a recession. So we're going to get a recession, then an inflationary environment because the Fed will respond. If we're at war, there'll be lots of money, government debt issuance, yada, 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 which is inflationary. But first is a deflationary scare. On the other side of it, they'll reinflate or attempt to. So this is going to be, I think, a quick risk-off scenario. It could be anywhere from 30 to 50% on stocks. And then you want to move pretty quickly to get a bullish again. We'll see what's going on then, but the policy responses will be enough to probably reinflate for one more last hurrah.
Could that be the reason why Powell is kind of keeping these rate cuts as a bullet in the chamber? I mean, that's probably a feasible scenario, right? Is that they're keeping rate cuts for when they really need them in case this thing really blows out of control?
Yeah, and people have to remember the rate cuts in the knee-jerk reaction in the stock market and the risk asset markets will be euphoria for a couple days. But historically, when there's emergency rate cuts, it usually takes 18 months for that to economically get into the system, to affect the real world. So rate cuts during a recession are actually bearish initially, and you kind of need to let everything wash out. And then once it's washed out, you get the green shoots, and then we begin again. There'll probably be another round of quantitative easing, that kind of thing. So you have to remember, during the great financial crisis, they didn't have the tools they have now. Now they have all sorts of tools. So, we have to watch very carefully what their policy response is. You don't want to, our opinion is this isn't going to go systemic. We don't think so. If it does, we'll let you know. But you have to be very cognizant of the fact that the rebound could be sharp and fast. So you don't want to be bearish for too long, but you want to be, as you notice, Warren Buffett's got 5.5% of the T-bill market under his control. He's been accumulating for 2 years. He's been early, as a lot of us were, because we didn't understand immigration and what that did to the economy. But he's probably going to come in during the crisis and pick up a bunch of deals. That's how we're saying people should, put their portfolios with some dry powder, take advantage of opportunities. And when everyone's bearish and jumping out windows and getting, and the headlines are as bad as they're probably going to get, that's when you want to look to re-enter the markets and get back into risk assets. So we're not gloom and doom. We're not the end of the world. We're viewing this as, a great opportunity to set yourself up for the next, bull market.
Right. And you did mention Warren Buffett being a little too early. Would you consider us still early in this process? Do we still have a ways to go, or no?
No, we're not. This is unfolding. We were early too. We made a call that there was going to be a recession at the end of 23, beginning of 24. We were wrong, and our economic cycle indicators had never been wrong. So we asked ourselves, have the laws of economic fundamentals changed? And the answer was no. What happened was we dropped 10 to 20 million illegal aliens into the country, and we didn't just drop them in without any help. We spent, our estimates are anywhere from 500 billion to 2 trillion of the U.S. Government treasure was spent on these illegal aliens washed via NGOs. So, and Stephen Miller came out and said, wait till you find out how much money the prior administration spent on illegals. And I think our thesis is going to be right. And that money flow is stopped, and it's going the other way. So that's that economic float that we had for 2 years is going away quickly, and it's going to create an economic slowdown.
And this is just coming to my mind. The $7 to $8 trillion of debt to be rolled over this year. You can't have these high real yields now, can you? With this huge amount, this gargantuous amount of debt being rolled over. How do we tackle that 7 to 8 trillion that's coming up for renewal this year?
Yeah, that's going to be difficult. But if there's an economic slowdown and a flight to safety, that should help out quite a bit. The yield curve might remain steep. They'll lower short-term interest rates. Let's say they lower them 100 basis points. The long bond and the 10-year probably won't go down as much, but they'll go down and provide some price appreciation. So I think they're going to be able to do this, not the way they want. They're going to have to do it into the depths of a recession, which no president likes to talk about.
Well, I think that's all I have for our discussion here today, Ed, unless there's anything else you want to talk about that we didn't get into.
No, I think we hit everything. One thing I'd like to say is our multifamily housing analysis, the level of construction we saw in multifamily housing, we haven't seen this type of construction activity since the 70s, which was the last multifamily boom. We suspect the multifamily boom was driven in large part by the illegal immigration, and that's going the wrong way.
Right. And does it require an ever-growing influx of illegal immigration for it to stay propped up? Because it's really happening now. We are seeing some remigration take place, but it's still at fairly low levels, right? Things like I think they're kicking out about a few hundred a day or something like that. It's a very small number of people. So my question is, even if there's very little coming out, there's not as much coming in anymore for sure. They pretty much sealed the border tight. But if they keep it at these levels and don't remigrate, can they keep the bubble propped up?
No, second derivative is very powerful. The stopping of, yeah. You need continue. Let's look at the .com or the AI bubble. In Q1, we had 1.2% of our GDP came from data center spend. That's like a huge 70% year-over-year increase. That is not going to be repeated. The second derivative on that is rolling over. That's why, I think the AI bubble is in the process of bursting. It's taking a while because they keep propping it up. But if you look at the long-term charts of NVIDIA and the AI darlings, they're not going to new all-time highs. So second derivative is very powerful in investing, and it's working its way through the new tenant rent situation. The new tenant rents came down in Q4 and Q1. They get revised up because it's a very volatile series, but the trend is down. So this is having an impact. And again, housing crises are slow to unfold. The housing crisis in the Great Financial Crisis began, at the end of 2006, beginning of 2007, when the subprime bubble burst in February of 2007. It took a while until the full crisis manifested. So there's going to be some feedback loops that are going to take time to rear their ugly head, but they're coming. And the second derivative has definitely shifted. The velocity of money is rolling over, the report we put out, the multifamily housing debacle, every leading indicator is rolling over. So it's only a question of when, not if. Right.
And for people who may have not taken calculus for a while, second derivative is equivalent to acceleration. So when Ed and I are talking about second derivative, that's what we're referring to. So essentially, growth is decelerating.
Correct. Right? Yep. Correct. And if people are interested in looking at our reports, our website's Finance Technologies with a PH. We have a product page. We got the U.S. Report, U.S. Dangers of a Deep World Order Recession report we put out in January. And then we have a bunch of other follow-up reports, which are cheaper if you just want to buy those instead. Give you some good insights into what we're seeing.
Understood. All right. It's a pleasure having you on, as always, my friend. Where can people find you if they want to see more of your work?
I'm on X at Dowd Edward, DOWD Edward, and on Getter at Edward Dowd. I mostly post on X, though. And our website, financetechnologies.com. If you sign up on our website, we'll send you updates of our free resource reports and our paid reports.
Awesome. We'll have the links to all those down below. Check them out, guys. If you got value out of this content, drop us a like, comment, go, Ed, go in the comment section. If you agreed with Ed's analysis, if you disagreed with anything in the video, that's fine too. But let me know what you disagreed on. I do, in fact, read the comments. So let me know your thoughts. Liking, subscribing so you don't miss another episode, commenting, doing all that stuff really does go a long way in helping boost this channel and videos like this in the algorithm. So let's go ahead and try to get this out to as many people as possible, make people aware of the situation at hand. And if you'd like to support me on Substack, you also get access to all my stuff early, ad-free, and uncensored, as well as the chance to ask my guests questions and bonus content Q&A. You get to ask questions and see the answers to the Q&A questions in the form of bonus content. So link to my Substack is capitalcosm.substack.com. Also linked down below. Be sure to check it out as well. All right, guys. Well, that's all I got for you today. Thank you so much for watching, and I will see you next time.